Hello, welcome to the webinar. Sorry we're starting a little bit late, but thanks for joining. We're just going to go through some of the budget changes. It's been an exciting budget, and those changes are sort of, I think, going to impact on a lot of people across the board, really. Some for more wealthy people, but not all of them are actually affecting more wealthy people. Some of them are just affecting ordinary income earners as well. So I'll just share my screen and we can get started. So there we are. This is just a little disclaimer that this is not tax advice. This is advice, just some general information about the budget. If you've got detailed tax questions about your situation, then we're more than happy to talk to you, but you would need to talk to us separately. The tax rates that we've been discussing in this slides are the ones that apply to England, Wales and Northern Ireland. Scotland has separate tax rates, so if you are based in Scotland, then that's a separate matter. Okay, so the key budget highlights. The personal allowance and tax bands have been frozen. National insurance bands have been frozen as well. So that's going to have an impact on ordinary income earners with physical drag. That is, people are obviously earning more, but potentially, well, there will definitely be more people paying tax and more high rate taxpayers going forward. Tax increases on rental income, dividends and interest. There's some changes to the amounts you can put into your ISA. And there's also the mansion tax to be concerned about for those owning property that's worth more than £2 million. There's issues with national insurance contributions on salary sacrifice pension contributions coming into play. Electric vehicle owners are going to get targeted. And there's also something called overseas workday relief. It's a very specific thing. If you've not heard of it before, it probably doesn't apply to you. It's a special relief that relates to people who maybe work across multiple countries. But we just wanted to flag it because there will be some people in our client base who are adversely affected by that change. There's some nasty changes on this temporary non-resident rules and how that applies where you've got your own private company. I'm expecting that might affect internationally mobile small business owners and contractors and things like that. So we will try and give that a bit of publicity, not only on this talk, but also writing an article or two about it, because it is going to be something that we just want to get out there, because I think the people who are affected may be just using accountants who are shall we say, lovely garden variety accountants who may be not aware of the complex changes and how that might impact on a small company. There's a few improvements. So we've talked quite recently about some negative changes in the agricultural and business property relief space. So this is to do with inheritance tax, where people own farms or businesses and then they pass away. So we'll talk about that in a little bit more detail shortly. And also there is going to be a cap on how much inheritance tax might be charged for excluded property trusts. So without further ado, we'll just start going through some of these changes and how they might impact on your tax situation. So I think that in general, that this is a very common tactic that governments adopt when they don't have enough money, is that they don't put up the personal allowance. They don't increase the threshold at which you go from a basic rate taxpayer to a higher rate taxpayer. And because they do that, what the impact is for the average person, as salaries and things go up, that you end up paying more taxation. It's not an uncommon change because people usually don't complain about it too much. But we're looking at potentially having had 10 years of actually not having any increase in the amount of the personal allowance. So that's kind of, it's not really a great change. This is the one that I expect most of my clients to be complaining about. So landlords have really suffered. I'd say they've been suffering for, I'm trying to think when the pain started for landlords. They banned, negative gearing has been banned in the UK for a very long time. Then the successive governments brought in a situation where you can't get a full tax deduction for your mortgage interest relief on your rental property. So that became another massive disadvantage. And now we're looking at an increased income tax rate for landlords, so that they'll now be looking at paying an extra 2% income tax at each level. So we'll be looking at a 22% income tax rate for basic rate taxpayers, 42% rate for higher rate taxpayers, and additional, which is actually the top marginal tax rate, is going to go up to 47% from 45%. And this is probably starkly different than if your rental property happens to be in Australia. This is starkly different than the way the Australian government view taxation of property income, because Australia does have negative gearing still. Australians were very against that, and you might remember a few years ago that it's one of the reasons why Bill Shorten, who ran for the job as the Labor Prime Minister against Scott Morrison, is one of the reasons why he's said to have lost that election, was because he was going to ban negative gearing. The average landlord, certainly in Australia at that time, was actually a middle income earner, and I think a lot of landlords are middle class people as opposed to the uber rich. Yeah, and there's something, I think there's really something needs to be done in this space, and people say, oh yes, but at least we're not taxing the poor. But there's a very adverse impact on poor people by having this kind of policy, and it's one of the reasons, in addition to obviously being concerned for the needs of my client base, it's also one of the reasons why I don't like this kind of policy, because it limits your ability to, it ruins the commerciality of the rental business, is probably the best way of putting that. And then there's less rental properties available. That drives up rents. It makes it hard for people to get hold of housing. The housing stock is there, but it's not being made available to the people who need it, because the business is uncommercial, and so landlords tend to sell off their let properties, which is why I do think people are going to need to be revisiting whether they should keep their rental property. If your rental property is out in Australia and you're planning to move back to Australia soon, great. But if your rental property is in the UK, or indeed it's in Australia and you're planning on staying in the UK, then you might still want to revisit this space as to whether your rental property is actually benefiting you or costing you money. And I do have clients where their rental property is actually genuinely costing them money. So I'm not quite sure what the government strategy here was, or how they thought this was going to be good in the round. But never mind. There's also something I'm seeing a lot with my client base, is they go to buy another property and find that because they retained their rental property in Australia, the main residence that they now wish to buy in the UK, for example, is caught to additional rates of stamp duty land tax. So that can be quite painful. Okay, so that property to income pain there is starting from 6th of April 27. From 6th of April 26, we're going to see a rise in the dividend tax rates at basic rate, and at the higher rate. So we're going from 8.75% at the basic rate to 10.75%. And at the higher rate, we're going from 33.75% to 35.75%. I think the justification for this was, well, there's no national insurance on dividends, but of course, if we think back a few years ago when the Tories were in power, they also increased the dividend tax rate because the national insurance, there was no national insurance on dividends. So I don't think the justification's quite right there, but okay, they wanted to put up dividend tax rates. What does this mean? It means you might look at accelerating payment of dividends before 6th of April 26. Certainly if you've got a lot of cash sitting around in a company, I think now is the time to be thinking about, do you want to leave that cash in the company? Do we get it paid out and suffer the tax? Is there any argument for liquidating that company and claiming business asset disposal relief? These kind of questions do need to be answered, I think, for anyone who's got cash balances sitting around in companies. If you're trading through a company, you might need to have a look at your remuneration planning and just see whether the current combination of salary and dividends is actually the optimal position for you now that the tax rates are going to change. There's also a nasty little rule if anybody here is considering becoming non-resident, for instance, you're thinking about moving back to Australia, and you do have a UK company, then you're no longer going to benefit from the basic rate tax, the tax credit at the basic rate. Now, this has been abolished for UK residents a long time ago, so it's hardly surprising that this has been brought in line with the other tax laws. Now, interest. It's a good topic. Again, there's this argument that the Labor Party have put forward that they should charge an extra 2% tax rate because national insurance isn't paid on bank interest. It's kind of a disincentive for saving, I must admit. So looking at a 22% tax rate for basic rate as opposed to 20%, the starting rate band still seems to be there, and that tends to be, it's obviously be useful to some people. And then the 42% higher rate and 47% additional rate. So basically everybody's going to pay a bit more tax on their bank interest. You might be saying, well, okay, what are we going to do about this? So we can have a look at what's going on with ISAs as well. They have made a slight tinker to the ISA limits. If you're 65 plus, there's no change. But if you're under 65, then you still get £20,000 per annum, but you've only going to be able to put £12,000 into the cash element of the ISA, and then the other £8,000 is going to have to go into a stocks and shares ISA. So I guess what's your options if you're trying to plan around this tax increase? And that might be something that you're thinking about at the moment, thinking, well, okay, but if you're thinking about investing money, where is it going to go? You've got increased dividend tax rates. Rental properties have not been a good deal for a long time. And interest, okay, if you can lock in a good interest rate, maybe, but really you probably want to put that interest in an ISA. If you're saying to me, well, I've used up all my ISA limits, I've done that one, what else can I do? You might think about offshore bonds, for example, or onshore bonds, but if you're planning on moving back to Australia, I would probably suggest an offshore bond. That can be used as a deferred tax mechanism, and you can withdraw 5% per annum tax-free while you're a UK tax resident. They haven't changed that, so that may be an avenue for you if you've got small amounts of money to invest. I think about the ISA route. If you used up all your ISA limits, maybe you need to think about perhaps an offshore bond structure, preferably one that is a life assurance policy in nature. So there's different kinds of underlying product structures with those offshore bonds, but you want the life assurance one because that particularly if you're going to move back to Australia, because that has some good advantages from Australian tax perspective. So there's a few things just to have a think about there if you do have excess cash and you are trying to manage your tax liabilities. The mansion tax. So as my colleague pointed out, there's plenty of properties in London that are worth more than £2 million that are hardly mansions. And in fact, a lot of them are probably apartments and not necessarily huge apartments either. So is this fair? Question mark. I think it's really a tax on London and the southeast, where property is worth a lot more than up north or in regional areas. It's going to be taxed. Is going to be collected when your council tax is paid, but this is actually going to go into the federal coffers in terms of the payment of that tax. So it's going to start at £2,500 per year and be up to £7,500 per year. I think the issue with this kind of change has, from my perspective, is that there will be people out there who have maybe got an expensive property. Let's say it's an expensive apartment in central London. It's not necessarily very big. They may not necessarily have a huge income because maybe they're retired, for example. Those kind of people are going to suffer badly under this change. And I don't think it was the right move, but we're stuck with it now. It's sort of a little bit along the tax the rich type philosophy that we're seeing happen in our taxation system. But I think there's already been, the rich are already paying quite a lot of tax, to be blunt. So there are going to be some people who just can't afford this, and I'm not quite sure what they're going to do about it realistically, because it's obviously going to make their properties slightly less attractive if buyers are going to have to pay this additional tax. Nothing we can do about that one, unfortunately. It's not coming until April 28, so possibly if people can't afford to pay this tax, I think they may have to look at getting a property that's worth less. Okay, this is next one's to do with NIC, obviously national insurance contributions. So previously, many people used to salary sacrifice some of their pay, and I don't think this is like just rich people doing this. A lot of ordinary people do this as well, where they're trying to conscientiously save for their retirement to pay retirement expenses, and the salary sacrifice pension contributions basically avoids employers' national insurance and employees' national insurance. So it's a good deal for the employer under the current system, a good deal for the employee. There's no tax, obviously, no PAYE, etc. paid when these pension contributions are paid over. But what's really proposed here is that, well, actually, you shouldn't get out of your national insurance contributions. What does this mean in practice? I think what this means is that for employers, and this may be small employers, big employers, medium-sized employers, it means their national insurance bill is going to go up. And we just had that increased at the last budget only 12 months ago. We had an increase to a 15% employers' national insurance rate. So I think this is sort of just another tax on business. So I'm not quite sure why the Labor government are of the view that this was going to be a good idea. Apparently, they're trying to encourage business, but they're going to tax business more. I don't quite get that. They're also going to discourage people on middle incomes, mostly, who take advantage of this. I mean, there are some wealthy people who take advantage of it, true, but the majority of people who are adversely affected are going to be people on middle incomes who are busy trying to save for their retirement. So it just doesn't, to me, sound like that this was a particularly great move. We don't know how that £2,000 per annum figure is going to be calculated, so we don't know if we can get round this rule by perhaps maybe the employer, next time there's a pay review, says, oh, well, actually, we're not going to give you a pay rise, but here we're actually going to put, an employer contribution in of 5% rather than the 3% we're required, for example. So maybe employers could volunteer to pay higher pension contributions, so that it can be clear that there's no salary sacrifice agreement. I don't think it's going to fix it if an employee is on X wage. So let's say the employee currently earns £60,000 per annum, and maybe they salary sacrifice £5,000 per annum into their pension scheme, and leaving them with a salary of £55,000. I don't think that that's going to give us an opportunity to then magically come along and put that £5,000 in as an employer contribution and just pay the employee £55,000 going forward under some new employment arrangement, because in general you can't just put your employees' salaries down. The employment laws don't sort of allow you to do that particularly easily. But what you might be able to do is say, if you were going to put up this employee's salary and their salary is £60,000 per annum, then maybe you could say, well, actually, I'm not going to give you a pay rise this year, but I am going to put another, say, £2,000 into your pension scheme. So that could be a possibility, but what we don't know is whether that kind of planning is going to be effective. Let's say instead, if I don't want to put £2,000 in as an employer, maybe I put in £5,000 extra per annum. Then is that going to be permitted to do that sort of thing? Is the compulsory 3% employer contribution going to be factored into these figures or not? So there's a lot of unknowns. We haven't got legislation yet, but it's certainly something that just to be aware of. It doesn't come into April 29, so you might say, look, let's try and get our pensions topped up before then and put in less afterwards. That's also a valid strategy. Electric vehicles. I think that someone's woken up and realised that we actually do have quite a lot of electric cars in the UK on the roads now, and now there's a desire to tax them, the electrics and hybrids, so they can presumably collect more contribution towards the roads. I think the only thing is electric cars are expensive, and a lot of people bought them because they could get out of the tax. And if they're having to pay the tax, is that going to disincentivize people to buy more electric cars? Possibly so. There's no indication of how they're going to actually work out how far electric car owners drive, or hybrid car owners drive, for that matter. So we don't know exactly when that's going to be implemented or how that's going to work. So it's a nice theory. I wouldn't be surprised if they can't work out how to put in the infrastructure to track these mileage. So let's just wait and see if that one actually comes in. It's all very well to be announced, but the cost of trying to track all the electric vehicles every time someone goes out is grossly impractical. If you're a petrol car driver, I've worked out my little Fiat Panda has less CO2 emissions than some hybrids. So, and also I don't have the complexity of trying to find somewhere to charge it, which doesn't work with my house, and that's a problem that other people are going to have, I'm sure, in trying to switch to electric vehicles. But the fuel duty is also going to go up from September 26. So it is costing more every time you go out. Of course, the winners will be people who are taking public transport, because they're capping bus fares and they're capping train fares, which is great, but we kind of need someone to A, get some more frequent buses, and B, sort out the there's the late running trains and all that kind of stuff. So I think there's a bit more work to be done in the transport space, but understand where they're coming from to some degree. But you've got to give people alternatives. You can't say they're going to stay home all the time, because they're not. People got to get places like work and go out and do some business and things like that. These overseas workday relief rules. So this covers a particular situation where maybe an employee works for a multinational group and they do work both in the UK and outside the UK. The amount of foreign earnings is now going to be capped to 30%, so this person would be UK tax resident. And it's coming in from 6th of April 26. So we've got a UK tax resident person, just to clarify, they work in the UK, but they also work overseas. Let's say they work in the US and they do some work in Australia and they're traveling around a lot. And so what the government's saying is, well, yeah, but we're only going to cap the relief that you get for your overseas work days to 30%. It can be interesting, though, the double tax agreement. It may be that people who are adversely impacted by this can get some advantage from the double tax agreement. That's something that's probably worthwhile looking into, particularly maybe if they tweak their situation a bit. So if they've got multiple homes and they're moving around the globe a lot, it may be that this kind of person might be better off changing their arrangements with their employer rather than suffering extra UK taxation. But yeah, if you are in that boat, please do get in touch. Right. This is a change to temporary non-resident rules. So let me give you a little bit of background to this one. Is if you go overseas for less than 5 years, so let's say you move back to Australia, you're there for 4 years, then you move back to the UK, then there's a bucket load of things that can come back into charge in the UK tax system when you move back. So you can find that income that you earned while you were non-resident becomes taxable in the UK, and the double tax agreement doesn't get you out of that. You can find that capital gains that you realised while you were in Australia, in my little example, suddenly become taxable in the UK. And again, the double tax agreement does not get you out of that. Now, you might be able to claim some credit for the tax that you've paid in Australia on that income or those gains. But it doesn't necessarily mean that there's no tax to pay when you move back to the UK. And in fact, it can be very, very expensive. So this kind of change, like initially this seems like, oh, well, this is an obscure thing. It's not going to apply to anyone. I think the kind of person this might apply to is a contractor who forms their own company. It's just them doing some work and they didn't bother getting any tax advice. And so they had a UK company, for instance. They paid some dividends while they were completely non-resident for the entire year, but related to some work that they did while they were in Australia, which incidentally the Australian government will probably tax under the Australian Personal Services Income rules. And then they moved back to the UK. And that person, after having those dividends paid out of their private company, then suddenly finds that those dividends become taxable in the UK. And actually, in my little example there, they might not get any credit for the Australian taxes paid. So what I'm trying to do is find people who are moving around the globe who are perhaps, for example, going to Australia for a short time and then going to move back to the UK, and just trying to explain these rules to them and make sure that they are set up correctly. So if you're going for more than 5 UK tax years, you'll be fine. These rules won't bother you. But if you're going for less than that, then you do need to be concerned. Anybody with a private company who's planning on paying a dividend while they're living in Australia, or in fact anywhere else in the world, but they're non-UK tax resident, does need to worry about this particular change if there's any chance that you're going to come back to the UK. And the government will look at residents as being resident under the statutory residence test in the UK, which is very easy to trip up. For example, somebody might be in the UK if let's say they've got accommodation in the UK, they've been doing some work remotely from the UK, and they spent 90 days in the UK in the previous tax year, and let's say they spend 120 days in the UK in a year, and I think, well, I was just visiting. The thing is, you might still be UK tax resident in that kind of scenario. So just be really, really careful around that, because it's a nasty little rule that I think is going to catch a lot of people out. Okay, inheritance tax. So last time we did a webinar, we talked about inheritance tax and how the farmers were adversely affected. We don't have a huge number of farming clients, I must admit. Most of our clients are not farmers, but what we do have is a lot of business clients, people who own their own businesses. So agricultural and property and business property relief are both being massively reduced from 6th of April 26. That's not a surprise. We already knew about this change. What we'd hoped is that the government were going to give us some way out of this problem. You will have seen the farmers busy out protesting over the last year or so about the farm tax, but this is what the farm tax is. But what we didn't really see is lots of business owners protesting, and quite frankly, they should have been out there protesting, because when they pass away, unfortunately, you're only going to get 100% business property relief on the first £1 million of assets. Now, the change is a welcomed one, because now that £1 million band, you're going to be able to move that between spouses. So let's say for a minute that the wife owns a business, it's worth £10 million. The husband doesn't own a business. The wife then passes away, leaving the business to the husband. Okay, so he has a business worth 10 million. Then he can actually claim £2 million of relief at 100%, because he'll pick up the wife's band once she's passed away, or vice versa. There we go. So it's a disaster for commercial farms. It's a disaster for anybody who plans to pass down a business as well. So I guess please do get in touch. There are still some tax planning options up to 5 April 26. I think beyond that is going to be a lot harder to plan around these issues. But there's a lot of pitfalls in trying to do the planning even now, in terms of trying to avoid UK inheritance tax. The other option, of course, is just to sell the business out, but then you've got a bucket load of cash that's still liable to inheritance tax. Of course, you could sell the business out, move back to Australia, make sure you're not a long-term resident by the time you pass away. That kind of strategy could work for you. But this is an issue for people. This is a peculiar change that's come along, is that if you were non-domiciled in the UK, as in you weren't from the UK, let's say you're from Australia, you were born in Australia to Australian parents, you moved over to the UK, and you set up what they call an excluded property trust. So that might be you settled a bucket load of assets on a trust in Australia. You might have done that. You might have settled a bucket load of assets on a trust in the Channel Islands, like Jersey or Guernsey, or maybe something like the Isle of Man. Some people set up trusts further away, like they might set up a Liechtenstein Foundation or something like that. And then now you've decided to remain in the UK, so you've been here for more than 10 years, and you think, right, I'm just going to stay in the UK because that works for me on a personal level, and the tax will be what the tax is. Fine. If that's your stance, absolutely fine to do that. But then that's sort of going to be capped at the inheritance is going to be capped at £5 million every time there's a relevant property charge. So there's basically £5 million every time 10 years elapses. Now, for our client, most of our clients, I would say that they're going to actually be paying the actual tax, because you have to have a lot of assets in an offshore trust to need to cap the charge at £5 million. So more likely you'll be paying 6% of the assets, which tends to be the normal level, a charge of up to 6% of the assets. So let's say more realistically, you've got £1 million or maybe £10 million in your trust. then you're only looking to pay 6% of that particular number. So it's not ideal, but possibly not as bad as it could be in terms of that situation. But we are seeing a general increase in taxation across the board, and hence we've just gotten to questions now. So if you'd like to ask questions, if you could just put them in the chat box up on the top bar, you'll see there's the first icon there says chat. And in fact, I'm just going to open the Q&A section. So I think we should be able to put some questions up, and if anyone's got any questions, I can go through them. Or if they're more personal questions, I just learned this from last time we did this. If they're more quite personal questions, because we are planning on putting this recording on the internet, if you could just try and keep your questions general. I'm happy to talk to anyone separately. Just drop me an email if you want to talk about your specific affairs, which was part of the reason why we had to re-record the webinar. Is there was too much client confidential information there, so we didn't want to make that publicly available, of course. So yeah, if anyone's got any questions, we can try our best to answer those, or otherwise get back to you if the questions are more of a personal nature as opposed to general. I think. Okay, we don't seem to have any questions so far this time, but feel free to get in touch if you've got any questions. And we can certainly help you navigate things. I think the general trend is that tax is going up, and it's not just going up for the super rich. I think it's really going up for retirees, for middle class people. It just is a little bit what it is at the moment. Hopefully things are going to get a bit better in terms of hopefully the government won't need to put up tax again next budget. But as a little bit of a capitalist myself, I think, well, what we really need to do is to start to focus on driving forward an economy that's going to generate more profits from businesses and things like that. And so employees can get pay rises and all these kind of things. More VAT will be paid, more corporation tax will be paid. If we can go in that direction, I think that would be healthier rather than more and more tax. But I don't think that's really going to be an initiative of the current government. So, and yes, someone has asked a question, will we be sending across the webinar, which we will be. We'll send across the webinar. We did start a little late as well, so probably haven't quite missed too much of it. So we'll send across a link. We have set up a YouTube channel which has got this talk on it. Well, which will have this talk on it, but it's also got the previous talk that we did. So anyway, have a lovely day, and hopefully the budget hasn't caused you too much grief. And that's all. Well, most of our team will have to get a new picture done because we've been joined by Beth since then. So, all right, have a fantastic day, and I'm sure we'll speak soon.